Q2 earnings call. For the ease of everyone who is joining for the first time on the call today, we have our Group CEO, Kasuri Chelraja Wilson, and our Group CFO, Zami Fazil. The structure of the call will be, first we will be having a macroeconomic overview, and we'll be discussing the challenges that has been faced by Hemas. Then we will be moving on to giving an update on our strategic pillars, and we will also be discussing the financial highlights. After that, we will be moving on to giving the potential that is there for our businesses, and also an update on the key strategic initiatives for each business unit, followed by the ESG updates, and ending up with the Q&A. So let's first of all move on to the macroeconomic overview. So in terms of the macroeconomic overview, we did see that there was a surge in inflation. So in terms of Hemas, the sort of the impact that we experienced was that we did see a volume contraction because the purchasing powers were affected, even in terms of industries such as pharmaceuticals. Another sort of aspect that we did see is that consumers wanted to purchase in smaller quantities, and they were looking for most affordable options that were available in the market. Even the most impact was seen in the non-essentials. Even in terms of Atlas, we did see that there was a certain drop that was experienced in terms of color products. The next challenge that we did experience was the currency depreciation. At present, the USD LKR trades at around 370. And in terms of Hemas being a primarily import-driven industry, most of our sectors did get affected, and sometimes we did see an overnight escalation in the cost of sales. Then moving on to the global commodity prices, we did see that quarter on quarter, in compared to last quarter, that the global commodity prices have shown a decline, but this the impact of this didn't fully materialize because most of the commodity price decline was towards the end of the quarter. Then in terms of interest rates, we did see that interest rates are in the range of 25% and above in comparison to the 6 to 7% rates that we did see last year for the same period. So all our key businesses, consumer, pharma, learning segment, did experience an increase in the working capital, and therefore our financial costs did get affected due to the dual impact of this. We did also see that there were multiple tax reforms that were already in place and are proposed. So we do see that the purchasing power pattern of consumers will be hampered, and there might be, of course, possibilities of a curtailment in consumption. In terms of the IMF update, we do see that there is certain commendable progress that is there in the debt restructuring, with Japan expressing its willingness to be a mediator in the discussions with the bilateral parties. But as things stands now, most likely we would not be able to go into for the executive committee approval in December. So the next executive committee meeting is, of course, in March 2023. So amidst all these challenges, Hemas was resilient, and how we were resilient and on our strategy, I would like to invite Kasuri to give us a brief on it. Kasuri, over to you.
Thanks, Hazel, and good afternoon, everyone. Listening that itself, it just depleted some of my energy to listen to the challenges. But look, we've gone through tough times as a country, as a group. We've gone through many tough times, and I sit back as a CEO and understand why we kind of managed to navigate it better than some, and we are standing at the end of the day. The key few areas I think we should highlight is, one is our governance framework. which forces us to be actually proactive in terms of how you look at crisis and address it. Given the fact that we are absolutely diversified in portfolio, but we also have diversified people running businesses. When a team has gone through successive challenges thrown at you and learn to come out and navigate and get own empowerment and respect diversity, I think that's a strength. And that's something we now understand really should keeps us apart from competition, is because whether it's engineers, lawyers, accountants, doctors, we've got them all in our senior management, and we've learned to respect each other. So that's a great part of it. Yes, of course, us being in defensive sectors is giving us an edge, but I mean, given the challenges we are going to face as Sri Lankans with the interest rates, with the consumption of consumers, we deal with local consumers. We need to be yet mindful that we come out of this. So that helps us. As you all know, Hemas actually had a very strong balance sheet. Even with our current borrowings, we're still at a 20% of gearing. There is capacity to move forward, but I mean, at what cost? But I guess it helped us, the AAA rating, which we've got for the third successive year, helped us to actually be able to operate the last 6 months a bit more better than the others. One big strength I saw is partnerships, whether it's local or global, and how we leveraged on that during all our crises, including the fuel crisis. It was not a single day was, we didn't have a down day, because even our distribution networks, and that's because our partnerships straddle over 30, 40 years. You find strong partners with us who have grown with us and who are big in their own territories, which helped us to navigate these better. So basically, these strengths, I think, would hold us through the next 6 months. I'm bracing. I keep telling our teams, let's brace for tough times to continue for a bit longer. But I guess what we call hold to our heart as strengths will actually help us navigate this a bit better. So as I've been always mentioning, we have 4 building blocks. We kind of break it up. Whatever chaos goes around us, we keep focusing on these 4 pillars. So the core was one thing which we really focused on for the last couple of years. And how would I measure success within the core is every business, every industry had, barring a couple of categories, we have gained market share right across the portfolio. We have consumer businesses who actually made their core stronger. We kept on innovating kind of packs or changing our variants and pack sizes to cater to the affordability point of the consumer. So you would find within the core, you would have had baby Sharmeen 70 gram, 50 gram variants of Shield. We also came up with a new product from an affordable category on the Diva, which is called Diva Diriya, which is we brought a low-cost soap washing powder, which helps people who want a low-cost, no-frills kind of a product, which is really out there in the market, and we've seen success with that. The ethos here is, look, we need to understand people's price points are hard-coded sometimes. Sometimes it's due to the disposable income, and we need to be able to cater to that without compromising on quality. Baby Sharmi actually got stronger during this time by making sure our clean value proposition is being stronger. So that means we invest a lot in R&D to make sure our product is the safest for kids. And how we give it more affordable is to change our pack sizes. Yes, we did see volume contraction in most categories. We did see a flat, not too much of the contraction in the beauty, but most categories did see volume contraction. But what we saw is we had our market shares growing in most of our categories. So I guess that gives us some kind of comfort onto that our core is strong. And on the learning segment, Atlas did, even though it was off season, we still maintained a 65% share. We're just getting into season. We put out our new design, so Atlas plays on design, and quite excited to see how it goes. And then on the core on Bangladesh, we saw a switch. So Bangladesh is going through its own challenges, but the sensitivity to inflation in that consumption market is really high in the category we operate in. That was all what we predominantly controlled. That was the value-added hair oil. And ours was Pomarica played in the premium segment. So while that part of the segment struggled, we actually invested, and we saw that Actisef, which was a soap, gaining huge traction. They moved from a revenue contribution of 9% to 19% within the quarter. So, and the same way you saw our healthcare portfolio being stronger, every business in the healthcare grew on market share. While we had challenges in your earnings based on the interest cost, but the solid through the share gains on the core. On the new within the core, we've got, as I said, 2 years ago, we started this innovation engine, and we made sure that we continue with this. So on HPC side of it, our beauty category, we entered last year with Vivia, which is doing decently well, and actually it's getting a push up due to the import restrictions on some of the beauty care products. We've solidified that with getting into the male category of beauty and grooming with Gold put in a 3-in-1 product for face, body, and hair. But Dandex, which was predominantly the #1 in the dandruff control, actually went into the family variant, which is for everyday use. So you made that proposition stronger with the use specifically for what you want for dandruff plus dandruff maintenance. So that variance came through. And our new baby Morrison, which is exciting. Leaving the buybacks aside, we started focusing on NPDs. We launched 3 new products, and all 3 are doing really well. And that's more exciting for us. So the next few quarters, our plan is to make sure we have a regular launch of our portfolio under our own brand. What's really exciting for me is the third pillar, which is the international, and that we have been consciously focusing quite a bit on our portfolio. It has grown by 50% off of small base, I must add. But what I see exciting is on an export angle, we've got a couple of markets on the learning segment growing on the Middle East side, Pakistan and Bangladesh. But however, we will also be investing in market presence due to the lack of FTAs, particularly in Bangladesh. We'll be doing some of these products will be getting into contract manufacturing there, which moves from export to international at that point. Some success on some of those contracts of B2B. We'll make sure that we are trying to work on getting some significant orders for the next coming year. But at least the fact that we have conversation with the big brands out there is interesting. So that's some place which will take a lot of my time going forward, and has been taking that for the last 3 to 4 months. That because we are quite keen on pivoting and taking the best of Sri Lanka out there. Efficiency, we keeping that because that's important for us. And that's the only way we can drive our earnings margin up in spite of all our inflationary costs. So what we've seen is most of the lean drives, the digital initiatives have kind of shaved off. We've benefited about 1% on some businesses. Some businesses are flat, I must say, in spite of cost increase, but some have taken off about 2% of their earnings margin. Yeah, basically that's my part on the new spaces and on the financials. Zalmi, would you take this on, please?
Thanks, Kasturi. Yeah, hi, good afternoon, everybody, or good morning or good evening, wherever in the world you are today. We had a good quarter. We had revenue growth, which was driven by price adjustments that was made to compensate for escalating costs. We saw, like Hazel mentioned, the market contracting, which meant that volumes were very, very subdued in the quarter, which was expected as an outcome of the current crisis that the country is going through. GP and EBIT margins of many businesses were challenged, and the increasing pressure from raw material and packing material, currency depreciation, operating costs, you name it, it was all negative there. So it was sort of pushing us down. But despite all that, we managed to make sure that we had recovered those costs out from the top line. Even though we saw global commodity prices declining on a quarter-on-quarter basis, the benefit was not realized yet. During the quarter, we expect that this momentum and the effect of this will come in the coming quarters, where we will see it hopefully translating into better numbers at the bottom. Finance costs, sadly, as Hazel mentioned, saw a 7 times increase in the quarter, primarily driven by higher interest rates and an additional working capital base due to the higher prices that we saw as a result of the depreciation of the currency. Increases in inventory was there in line with revenue growth and managing supply chain disruptions. And of course, this resulted in the need to maintain buffer stocks for all pharma, Atlas, and home and personal care, Sri Lanka. Receivables are in line with our year-on-year and quarter-to-quarter growth in revenue. So if we look at it from a days of sales outstanding, we are mostly flat, or we have seen marginal increases. But of course, in terms of absolute rupees, the number has grown mostly because of the higher revenues that we have seen. We have seen a slowdown in collections, especially from the government. And this has no doubt had an impact in increasing the amount of government receivables. Making an impact on our working capital, which obviously should have been at a lower level if we had collected the funds. We also saw a negative shift where, in previous quarters, we had actually accounts payable, where we were enjoying credit facilities out for our import suppliers. But due to the constraints that we have with the banking system today, or during the quarter that we just passed, we were forced to switch in certain cases to advance payments. Even though suppliers were happy to provide us with LCs on deferred terms, banks were unable to allow us to do that. So we couldn't actually capture those opportunities in maintaining or controlling our working capital increases. As Kasturi mentioned, as Hazel mentioned, our gearing remains at around the 20% level, which is still at a pretty reasonable level, given that we have adequate headroom, both in terms of borrowing capacity and also having unutilized lines that we can draw down if and whenever we need. In the quarters to come, we expect that working capital pressure is likely to subdue. Maybe not to the extent that we would like it, but we would see that gradually starting to slow down a bit and giving us a little bit of breathing space. Forex liquidity pressure was present during the quarter, yet we managed our working capital in a way that we prioritized and rationed the availability of dollars as we needed. And thankfully, we are thankful to our banking partners and also to the other authorities for continuously supporting us to ensure seamless supply of goods into the market. I think I will hand over back to Kasturi now to take over the specific business segments. Kasturi, over to you. Kasturi, on mute.
Sorry, okay. So I start with the consumer brands business and to try to give you a look on how we have progressed here. So you see the financial numbers, but what we've seen demand contracting. However, what we've seen is that in that space, as I said, that we've kind of pivoted and make our products stronger and giving options to the consumer. So we have had our shares growing. The learning segment, while back to school has been delayed, we've also made sure that we have been fair in understanding the consumer prices. So we've taken calls to make sure we maintain prices at a decent level so that there is no impact there. But what learning segment has done during during the time. This quarter is invested a lot on exports and new business plus the digitech learning tech part of it. So the outcome you see is we've seen a good quarter 2, quarter 3 and 4 is where the learning segment kicks in. And then the business of Bangladesh has been flat this year. We're waiting to see how the next 2 quarters. We would be doing a couple of, there'll be investment in Bangladesh for the next, in quarter 3 and quarter 4. So we would be expecting the flat, we won't be expecting too much of earnings to come out of that, because we have taken a conscious call to invest into some new categories we are entering into. The next one is just to give a potential of the space itself. We strategically will be looking at premiumizing some of our products. We, as you know, as I said, we went into beauty last year. It was not just a one category and one product. It is, or just a product. It has, we've went in with Vivia. We've got SWA, which is a natural range of salon beauty products, which is doing well as we have strengthened the goal proposition for men. In the soap and the laundry category, we would be going up the value chain just to offer premiumization for the consumers who want that. Skincare and beauty would be a big part of our focus for the next couple of quarters. On clean beauty, something I'm very keen on, whether it's baby, whether it's adult. And I think Sri Lanka has the ingredients, which is natural or chemical, to make sure that we own that space. And that's a space we have started investing on. And because when you look at the regional markets and you look at global markets, that's a growing category. And one of the few things we kind of debate to see where can Sri Lanka play, and that seems to be a place we can play. So that's another area of new growth we'll look at. Yeah, and on Bangladesh, a bit on the learning segment before that, the EdTech place is something we launched early last quarter. And it's more, we started this on top of our purpose-led initiative of the grade 5 scholarship. So, and this started pre-COVID. During COVID, we just had engaged these customers, these kids, on a learning platform just to make sure we engaged and made their parents' lives easier during COVID. But we had this whole platform with 50,000 kids engaged with us. So we kind of unleashed that into a tech platform with exam-based learning platform with the best-in-class teachers engaging with them. We've operated for 3-4 months. Now they've moved it into a model of revenue. We will see how it moves forward, but this is a place we want to crack as well, because we actually had the equity for that. Basically, that's and in the learning segment, if you look at the 2 markets we've all entered in, it is Bangladesh and Pakistan. And Pakistan is doing, in spite of it, that's my, I was amazed, in spite of the challenges Pakistan is going through, it is doing very well. But the category is not books, its categories are pens and color products, because Sri Lanka doesn't have strong FTAs on the books category. Bangladesh is the same. We're doing really well on the back to school products. Our books, even though we are exporting from here, are doing well. And we'll have to have a strategy to understand how we enter those markets and own our space. And there's a particular space we can own with a better margin there. So Bangladesh consumer is, if I go to the next slide, which is Bangladesh itself, the consumer is, it's one of the growing economies. While they have their own challenges, you have the middle affluent class, they call it the MAC class, which is the fastest growing segment. And I guess if you are early in it, in that journey, we could really cater to that market on the more premium, affordable category. What do we have there? We have 13 years of experience. We have a team we have marketing teams there. We've got sales teams there. We've got channel access. We know how to understand that consumer and we know how to create brands there. So, and you layer that with a channel capability, you have something to unlock. So we are taking Bangladesh now as a country view, and we will be doing business in there to unlock, use the advantage or the assets or the strengths we have there to leverage on that and see what business we can do. So there are some interesting conversations we're having, but that's an interesting market in spite of the challenges that country is going through. And the healthcare sector, that this sector has been defensive. Their revenue growth reflect the demand we've had, and I think being a large player, we've managed to grow during this tough period. However, I think one challenge we will see uniformly right across for the next quarter as well is a challenge of working capital or the cost of working capital. The challenge on working capital is twofold. One is with the devaluation, whatever $1 has doubled in terms of rupee values, right? And when you're large enough, you have that the amount of value of credit you need. The second option is we don't enjoy credit as such. We kind of move through advance. We do have a part we get credit, but the balance we had to put cash margins up front. So you kind of bloated your working capital value, which in turn came into high interest costs. How do I look at it? Do we, while we manage the drivers of cost effectively, we need to see through this and push through this, and hoping that the country stability would bring some sense into the interest cost as well as the instruments they have available for us to import medicines. Hemas actually had one win, which was the Hemas DigiHealth, what we call is a blueprint for Hemas hospitals, which we continue to go on, was shortlisted by IFC on a business transformation awards 2022. Yeah, we were one of the 3 companies in the world which were shortlisted in that category, and that was the thing we were proud of. We'll be very keen on getting the execution completed in the next couple of years. Yep, and on healthcare, you could see that the big opportunity we have is in our pharma, on the capacity where we can unlock is in the pharmaceutical plant. And we have over 5 new products in the pipeline to cater to the therapeutic segments, which are in the NCD space and vitamins. And remember, that's the high growing space in Sri Lanka. We have seen that since we have taken a conscious call of giving affordable quality healthcare, we've also seen big brands also bringing down their price in the new products we launch, which I feel is a good thing for the country. But this doesn't come without its challenges, because end of the day, we are not a science driven. So we need to invest in getting the new molecules, the science in. Luckily, we have our partners we have leveraged on. We've, I think in the next 2 quarters, the last batch of contract manufacturing will finish stability, and we would be putting out these into the market on behalf of our global manufacturers, and that will be under their brand and not ours. Yeah, so that's the bigger part of it. Currently, it's on the low single digits of utilization, but most probably we are targeting at least about 25% within the next 6 or 8 months. Yeah. Then we would talk about Hemas hospitals a bit. The new thing, what we actually did open was a renal care facility, which is the only one in the country which is purpose built, and it's isolated for terms of infection control, from a point of view of handling the patient itself. That was launched last quarter, and I'm just hoping that we could just make sure that our cardio specialty can also be kind of invested on in the next quarter. So on the renal, we have performed 19 renal transplants during the quarter, hoping that we can use this asset to give service to more people, maybe even for the region, because this was invested so that even regional people can use it if needed from terms of infrastructure. The mobility segment, of course, due to one is the global freight rates coming down, but also consumption coming down. We saw throughput coming down right across, whether it's air or sea, and that made the volumes come down in our maritime and aviation business. On the aviation side, the frequency was reduced to directly one, I think Emirates, and one via Male. Reason was twofold. They still do have an issue with the country stability and the money is being remitted out. But now we've cleared it for our principals. I think the local banks have done it for all airlines. But the second issue is they also had an issue on fuel, and operating that with payload restrictions was not making it viable. But the good news is in December, they would be increasing frequencies into Sri Lanka. The last we heard was that. Hopefully they will stick to that commitment. Yeah, and Hazel, would you take the environment?
Thank you, Kasturi. So in terms of the environment impact that Hemas has made, the first big project that we did do is to launch our environmental agenda by the name of Haritha Mehevara. So this is a long-term commitment to protect and to, of course, conserve the island's critically endangered species. So just to give an idea, in terms of Sri Lanka, there is around 1,900 endemic species, out of which, of course, 413 are endangered. So Hemas is going to partner with WNPS, that is, of course, the Wildlife and Nature Protection Society, to protect 52 of these critically endangered species. So the other project that we have done is to partner with the Clean Ocean Force to safeguard the Negombo's threatened ecosystem. So here our plan is to remove an estimate of around 350 to 500 kilos of plastic bottles, and also to another 100,000 kilos of other plastic, including cans and other pollutants on our weekly and bi-weekly removal initiatives. So also to give more context, to date we have 1 ocean strainer trash trap and 5 beach caretaker projects. So up to date we have collected over 11,000 kilos of plastic. So Kasturi did touch upon the governance aspect, so we'll move on to the more social aspect. In terms of our support to the communities, Hemas Outreach Foundation did construct a 61st Piyavara preschool that is in the Ampara district. And also, Baby Sharami did celebrate 60 years. And in terms of that celebration, we did launch a parental education program by the name of Darupatiyata Surakshita Loa. So in terms of that, we have planned around 30 clinics in association with the Ministry of Women and Child Affairs. And the first clinic had over 400 mothers and fathers attending this. Then our Komarika Purpose project, which is Sunduru Diriyavanti, celebrated 1 year of impacting the lives. And therefore, we continue our efforts to provide around 6,000 natural hair wigs and care packs to around 10 cancer hospitals that are there around the island. And we are also happy to state that most of our staff members have also been part of this project by donating their hair. And in terms of moving to the more sustainability aspect, so Hemas, of course, has in place a comprehensive ESG management framework, and we are continuously monitoring our impact on the material topics on a quarterly basis. And we have made progress in terms of these aspects. that's the update we have in terms of ESG. Kasturi, will you be please telling us about the focus areas and our short-term strategies to navigate this pandemic?
Yeah, so on the focus areas, I mean, before I go to the business side, on a society side of it, we will still continue our commitment to society by supporting our investment in creating a social net, whether it's the food security or medicine security, and any of the purpose-led projects we've funded through the brands we have. And we're mindful that this would be needed from a long-term perspective. On a business side of it, the core business has few key targets they need to achieve, which is our market shares is something we would be not wanting to, we'll want to protect and grow. But our innovation and new products would be something we'll be accelerating the launches on it, particularly which are any product which is exportable. Our regional footprint, Bangladesh is, as I said, we would be doing more there. So there'll be investments going in this quarter into Bangladesh, and that'll be a focused international market for us as Hemas as a group. The biggest challenge I see in the next quarter is access of working capital, because I can see banks also shrinking their credit books, but how we navigate that and how do we navigate that at the lowest cost. So there would be those challenges, and how do we look at cash flows and make sure that our belts are tightened there. So that's basically that. We would be looking at, even in spite of challenges, we'll be looking at our talent. We've also, like others, seen attrition at a certain level of talent, but we've not seen it at the same percentages IT companies or see it, but we have seen it. We will invest in acquiring as well as developing our talent at this time. We will also be looking at how we can support our SMEs and looking at if there are any acquisitions. We'll be looking at growth as well. So basically, that's my short term. On a medium term, on medium term, I would look at the areas we look at is the acquisitions, as I said, or growth in those, particularly in consumer and healthcare. On the international and export part of it, that'll be something we will be really focusing it on. So it'll be short to medium as well, because I think one thing we need to figure out is what is our exportable capability, which we figured out, and products which we figured out. Now we have to leverage on the 1 or 2 orders we've got, and how we can get more out of that. So the pharmaceutical export, of course, it's going to be medium term, because as you all know, from a cycle perspective, you need to have 2 years of in-market sales before you can even go out and look at export. Now that we started our in-market sales, so this in the medium term, we'll be looking at market access through our partners and network we've got into regional markets, and what can be exportable in the pharmaceutical range. Yeah, so that's basically it. We will be looking at an exportable portfolio. We export our existing portfolio. Now we're changing the view of, while having that, how do we create a portfolio which is exportable? And that's something which we'll be doing for the medium term. Yeah, overall, other than that, we'll continue to make sure that our belts are tightened, and especially this quarter, where every penny we save, we are saving 30% in terms of interest cost. We will look at our talent. We know that the reforms the country has to take, or tough decisions the country has to take, would have an impact on the businesses and the people who run the businesses as well. The impact on all of that and our market itself, or our consumer, might be different. Healthcare, it might have an impact, but in the consumer business, I'm still not clear whether our consumer is going to get, in fact, impacted a lot in terms of the income tax, or whether it's a different consumer. But from a people side of it, we are mindful that there'll be plenty of challenges when some of these reforms, which are necessary, maybe need to be executed. What we as a group would support reforms, but it has to be equitable, and I think everybody should be participating in taking some of the pain, and that's my personal view on that. Yes, that's I'll pause here and let maybe open up for questions at this point.
Kasturi, we've received one question from the chat box, but before we move to that question, Asanka has his hand up, so we'll take Asanka's question first, Kasturi.
Yeah.
Hi,
good afternoon,
Asanka.
Kasturi and Salmi. Can you guys hear me?
Yes, we can.
Yeah, Asanka. I can't see you, but I can hear you.
Right. I'm sorry, my camera is not working. Hope that is fine. Just to so I have few questions. Let me just start off with the first one. So essentially on the consumer brand segment, we are seeing the margins quarter on quarter improve. If you can explain it a bit, is it because of the price increase that in absolute terms your profit per unit is better, or is it something else?
No, so Asaka, if you recall Hemas, last year I said that we were challenged in margins. If you recall, we dropped from our high GP margins down because the global commodity prices took us, like it rolled in a way that we couldn't even pass it through to the consumers at that speed. And if we took a call not to pass it in that speed. So we took a hit. So today is what we've done is we're slowly clawing back. We will not come back to that space. What your price increases were purely taken to offset the commodity price increases. What we don't see, and we since then, we have not come back to the 2 years ago margins as yet. And what you see clawing back is the improvement is us clawing back some of those elements we didn't claw back last year. Yeah, and that's it. And basically, of course, in the factory, we have also been doing some of the lean initiatives, which started trickling in the last quarter. That's basically it. What we have not done is taken excessive to pass on inflationary impact on the local cost elements. We have not taken an increase for the social tax. We took a call to absorb that within our costing. However, we are waiting to see how the global prices move down to a certain level where we can pass through costs. At the moment, we don't see that moving to the level we can pass down costs as well, because we've absorbed some of the costs.
Right. Kasturi, I think everybody is witnessing a decrease in volumes across the various types of consumer products. But if you look at your product portfolio as profit into units that you sell, is there a sense that the volumes have not declined to the extent that your profit into volumes has begun to decline?
No, it hasn't. So our volume decline is less than the market decline. So that's reflected in the prior shares. On profit to volume, we still have not declined. That's because we have been periodically right sizing also. So yeah, but there are some categories, I must say, which are non-essential. We see profit to volume declining, which are not our big brands.
Sorry, go ahead.
Those are not our big brands. So if I talk particularly on the big brands on consumer, and if you talk about the baby care brand, and if you talk about the home care brands, those have been maintained. And the beauty, actually the beauty is doing decently well, yeah.
Maintained and actually share grown, no, Kasturi? I mean,
yeah. No, the profit to volume, yeah. So that's reflected on that, yeah.
So that the two theories that the larger players may do better, and the fact that the defensive consumer demand may hold are getting played out. Is that the case?
Yeah, so the volume decline you see at Asanga, one is the absolute say a toothpaste is used for 2 months versus 1 month. A
Right.
soap is used by like previous family household. I mean, these are some of the household habits I've seen coming out of our insights. So your daughter will use one type of soap and the father will use one and mother will use one. But now they move to family soap, right? So that is one aspect. The second aspect is, we've all downgraded our pack sizes from 100 gram to 70 to 50. That alone is a volume contraction. So those, you will be unit-wise, it might be still having growth, but in absolute grammage in the tonnage size, it will be low. So your question of do big companies survive? My answer to you is the more agile companies would survive in this.
Understood. I've got a couple more questions. Hazel, shall I come back to them later or you want me to ask them now?
Asanka, we can take one more question and then the rest you could always reach out to us on IR.
Right. Okay. My other question is on Bangladesh. That now I presume that Bangladesh is accounted in taka and then it is converted into rupees for the purposes of a group reporting. So to that extent, in the rupee numbers that is reported for the Bangladesh segment, is there a currency benefit that is not expressly visible?
So Asanka, we actually get Bangladesh reported into us in dollars, and that we translate into LKR here. So you are right in terms of LKR. There is an advantage. There is obviously there is an advantage, or there is a plus point
Currency
when the currency benefit comes in on the translation.
So it's like an export, right? But the only thing is it comes into, so Bangladeshi currency against the dollar has devalued by 15%. Yeah, yes. Approximately about 15%.
Approximately, whereas the Sri Lankan rupee devalued much more. So we actually net against the rupee, we are actually positive.
Did that answer your question, Asanga?
I think he's on mute. No? Oh.
Yeah.
Yes, that did answer. Zalmi, what kind of a benefit was there? I'm just trying to understand what was the underlying profitability of Bangladesh.
Asanga, Bangladesh is, on the grand scheme of things for the group, is not very, very big. So it gets, the impact is not material at the group level. Because you remember, we take the giants of pharma and Mori and even FMCG in Sri Lanka and Atlas, you club it together, then Bangladesh becomes a very small slice there.
Understood. Hazel, thank you for the opportunity. I'll reach out separate for the rest of the questions.
Sure.
Yes, please. Thank you, Asanka. There is one more question, Kasturi, appearing in our chat box. It says, how is the competition in Bangladesh and Pakistan for your learning products?
Yeah, I mean, that's a good question. I mean, we had to study that in depth before firstly, of course, the size of Bangladesh is an interesting space, but then we had to figure out where do we have the right to win. So there is competition of about 4 big players who play on the mass side. And then you don't have anything for the middle, which is the upmarket. So where Atlas's strength was in the design and the quality of products, so which you don't find that in stationery there. You find evolved pen competitors in the pen segment, but not in the stationery. So competition is there, but competition in the place we are positioning ourselves, it's very poor. There is not much competition. There's no competition in that. So we are trying to play in that segment. We might play in a smaller segment, but we believe that the call we're taking is that's going to be the growing segment, and let's be part of that early. That's how we have positioned it, and we have gone into the market. You have the Basundaras who have paper mills. You've got the same Matadors are there. So there are 4 big players.
Kasturi, we have one other question. It says, with the palm oil prices coming down quite significantly, with usual lag effect on the costs, do you expect the margins to go higher in the consumer segment or to at least remain at these levels?
I'll have to answer that in a way that, look, the margins haven't gone back to the old levels we've ever enjoyed, right? But given the country's economy, we'll maintain it at these levels and we'll pass back the benefit, if at all, we will to some benefit to the consumer. But as Dalmi said, we still have not seen that total benefit, because while palm oil costs have been coming down on this side, all other local costs have gone up, from the social tax to the interest cost and the inflationary impact to the rest of the inputs. So we've yet to see the electricity cost increase has to be factored in. So from that point of view, I don't think our margins will go up, but we will maintain, and whatever is remaining we'll give back to the consumer.
There's another question that's appearing, asking our quarter-on-quarter growth in terms of revenue. So the answer to that is 9%. A small analysis has been provided for ease of reference if required in the CEO's review that was published. We haven't received any more questions. If anyone has any questions, we have like 5 minutes more. Otherwise, we could round up the call for this quarter.
So there is something about the Harindi has put something about the pharma plant. Am I seeing it, or?
Yes. Yes, Kasuri, that question, it says the new pharma plant, what is sort of the break-even level capacity?
So currently we are using about 5 to 7% of capacity of the plant, right? If we continue with the same mix, there is a lot on the mix. If we continue the same mix, we should break even between 35 to 38% of capacity utilization.
Actually, the mix plays a very big role in terms of working out the capacity utilization at any plant, really, not only Mori.
Kasuri, we have got another question asking, can you talk through how volumes trended through the quarter?
Yeah, so I think from a market perspective, what I can see is the volume decline overall has been worsening towards the end of the quarter from a market perspective. We couldn't actually see what the impact on our absolute demand-based volume contraction was, purely because we had supply-based issues as well. Not as in, it was disruptions because demand side picked up and we couldn't supply based on the requirement we needed. We kind of had, especially for the big brands, we did have a couple of pockets of out of stock, which is now regularized. So I wouldn't be able to say exactly what we felt, but for us towards the end, there was an increase in volume, but it may be predominantly based on just that we got supplies in order. So from a market perspective, we found that the month of September towards the end did have an increase in kind of a market contraction, but it's just a small increase. Market contraction is anything between 20 and 25%.
There's another question also asking, is there any benefits spilling over to Hemas Healthcare or in terms of pharma with GSK leaving the Sri Lankan market?
So GSK had a couple of so they have the originator brand, and basically in the antibiotic range, and then the antihistamine, I think they have some of those, and the vaccine and the injectables. On the antibiotic, yes, there would be alternate brands, but some of those others, I don't think we have very good alternates in the market because it's a niche place. So we only in the antibiotics or the common categories they play in, we would be able to get some uplift if our principals are up to it. Yeah.
There's I think one last question, Kasturi. They have asked an update on the buyback volumes and in terms of payments.
Payment, I don't think we've between both pharma imports and manufacturing payments haven't improved with government. And because of that, I think not having proper buyback may be a benefit. But having said that, we've been getting some ad hoc volumes on the new molecules we have put out with the government. So we are quite particular on the terms of supplying those though. So buyback is not come back to the normal level. I mean, it's still they're taking that principle of, I mean, they had a conversation and it was like, we're giving all SPMC the first chance of first allocation, which is people like Hemas will survive. But if they are to attract investors in that kind of policy or way of allocation, wouldn't be able to attract investors in. So the collection is something that I think we had to battle it as an industry, but it is slow.
Final question for the session, Kasturi. They have asked, have your occupancy level increased in the hospital segment?
Occupancy levels would have been increasing by 1-2%. Remember, we've always had decently high occupancy levels. So there is nothing which we can extract out of that. What I can say, what has increased is conversion into our surgical numbers. That percentage has increased month on month and year on year.
So thank you everyone for joining our session today. In the interest of time, if you couldn't raise your questions, you could please reach out to us on ir@hemas.com and we would be happy to get back to you. So thank you very much everyone and have a pleasant day.